Chat with Traders is sponsored by Plus 500.
Ever thought about dipping your toes into futures trading, but felt lost in all the jargon? I get it. Trading can seem overwhelming at first, but here's the thing. With Plus 500's futures platform, you don't need to be a financial expert to get started. With Plus 500, you can access a wide range of markets: S&P 500, NASDAQ, Bitcoin, natural gas, Forex, metals, crypto, and more. It's like having the entire financial market in your pocket, since you can also trade right from your phone. Open your account with Plus 500 and start trading with as little as $100.
That's right, Ian. And if you don't want to risk even a penny, Plus 500 offers an unlimited risk-free demo account packed with real charts and tools to help you practice and build confidence before jumping in with real money. With over 20 years of experience and over 30 million global customers, Plus 500 is your trusted gateway to the futures market. Visit us.plus500.com to learn more.
Like, even though I was starting to get financial abundance, I didn't trust it because I had never had it before. All I knew was going to work, shave my face, put on a tuxedo, wait tables. So when I started making money, I had trouble trusting it. I was afraid that it was going to go away. And I knew that it would have been my fault. Like, I had enough self-awareness to know, like, it's not going to be a market correction that puts me out of business because I don't have that type of risk on, right? We're carrying... over the years, I got much more aggressive in the mid 2000s, but in the mid to late 90s, I would go home with maybe 10% margin to equity ratio, which is kind of like where the CTAs kind of live. When I got really, really good and I had over 10, 15 years experience, when China was buying everything in the mid 2000s, I'd have 70% margin to equity. Like, I was levered up. So mental errors were, don't get haughty, don't get full of yourself. This has nothing to do with intelligence. Intelligence is important, but it's not how you make money. Making money is about knowing good trading tactics. And can you pull them off? Do you have the will to do it? And I was afraid. I was absolutely petrified because every time I put on a trade, I felt like kind of like I do now, like on the witness stand, and that you have to pass muster every day, and you kind of do, but it's not because you're smart or stupid or you're lacking something intellectually. Trading is about adding risk with an appropriate dosage. What is your risk unit? Like, coming from a hedging, being physically trained in commodities, you know what your needs are, so you hedge for your needs. But when you're a speculator, you don't need anything. So how the hell do you figure what the right position size is? That I had to carve out of stone and figure out for myself. And when I lost money or more money than I had wanted, it was very, very hard on myself. And I said, okay, but trading is like sex in many ways, or other things in life that is largely experiential.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Welcome to Chat with Traders, episode 299. Hey, how you doing? Today, my co-host Ian speaks with a special guest, a professional futures trader of over 30 years. His name is Michael Martin. I just love his New Yorker accent. Look, I only wish I had the New York accent. Growing up in Southern California, I kind of grew up with that Valley Girl beach accent. Like, for sure. I think I totally got rid of it by now. I'm Tessa, Ian's co-host, and having a little fun with you. And I'm just so excited about sharing this interview with you. I promise it's not about cool accents. It's about this awesome gentleman by the name of Michael Martin and what he has to share with all of us. In fact, several of our past guests on the show were actually referred by Michael. Raised in a hardworking blue-collar community, Michael embraced that same work ethic. Hardworking, resourceful, an entrepreneur at heart, he hustled from cutting grass when he was 12 to working all types of jobs, including golf caddying and waitering at restaurants, to starting businesses. Determined to transition into the white-collar working world and being at the right place at the right time, he was exposed to the financial markets. Michael's interest in trading commodities futures originated during his time as a student. During an unexpected work-study program, he was introduced to developing seasonal models for heating oil and natural gas for a major hedging firm using spreadsheets, and he was great at math. He subsequently worked on Wall Street, managing commodity accounts, and despite the significant commissions, he realized that he could potentially earn much more through an incentive fee. So after 3 years at a brokerage firm, he started his own CTA. I sense that he has a very intuitive style about him in trading, business, and in life. And I promise this is not just going to be another interview. It's engaging and there are lots of golden nuggets to take away with. So you don't want to miss this. Also, we've added a bonus behind the scenes segment for this episode where I put Michael on the witness stand some more with some questions. So you're welcome to tune into that segment at the end of the interview. Also, guess what? As a gift to you, just because Michael's cool like that, we've included a link to Michael's audio version book, The Inner Voice of Trading, for free. And it's in the show notes of the episode of our website. Get it while it's available. Thanks, Michael. So to get it, just visit our website, chatwithtraders.com, then navigate to this episode, episode 299, and you'll find the link in the show notes. Enjoy. Ladies and gentlemen, we are so pleased to introduce Mr. Michael Martin, originally from New York.
Well, Michael, I'd like to welcome you to Chat with Traders.
Thank you very much for having me. It's a great show. Honored to be here. And I don't say that lightly. I know who you've had. I've referred a few people to the show, and it's good to finally connect.
Yeah, likewise. So where are you now and where did you grow up?
Right now, I'm in the Los Angeles area. With my accent, you can tell I'm not from Kentucky. I was born and raised in New York. Grew up, about an hour north of Manhattan. Found my way to New York, went to college, went to work, kind of made my bones, cut my teeth back in the day before the internet, when stocks traded in eighths and commissions were, 1% to 2% every trade. It was very expensive to be an active trader back then. So that was a good environment for me to learn how to trade, cut my teeth, and only trade when I have an edge.
Just prior to getting into trading, what did you do, and kind of like how did you first get introduced to the markets? By friends, family?
Yeah, a little bit of both. I had, I was the baby in my neighborhood. Everyone was either 2 to 5 years older than me, which, when I'm 11 and your friends are 16, there's a monster difference there, in terms of human evolution and the things that are important to you. When you get older, those kind of numbers don't mean much. So those kids had either become cops or firemen, several of them, and, rented seats or bought seats on the exchanges, the Amex, New York Stock Exchange, or they became locals in the commodities markets. So that was my first introduction because they were out working. I was still in college. And then just by being in the right place at the right time, where I went to school at the time, they were the third largest landlord in the city. And so they were big users of natural gas and heating oil for electricity and for environment control in the winter, respectively. And they didn't have a hedging plan. And just by luck, I was in the right place at the right time with a work-study job where I helped them look at seasonal tendencies in energy markets to design a hedging strategy.
So you were helping them design a hedging strategy. Was this before you got into actually trading, or I assume this is involving commodities? So how did you learn about that?
So I went to the exchange and I actually got the data. In those days, you had, combination 5 1/4 floppies and 3 1/2 floppies. Lotus 123 was the dominant spreadsheet of the day, and you had about 3,000 rows. So you could get 9 or 10 years worth of data. And what we would just look for is what are the seasonal tendencies when prices would appreciate and could cause problems, because, of all the schools under the university umbrella, there's probably 25,000 faculty and students who were basically on rent control. And so worked into the price of the rents and the leases were energy costs. And in New York, you definitely have very, very cold winters that you need to have heated apartments and rooms and dorms and this and that. But also in the summer, it's hazy, hot, and humid. You can cut the humidity with a knife. So people, put their ACs on. And if someone else is paying the bill, they're not turning the AC off when they go out. They're going to come home to a nice, cool apartment. So if there was a spike in prices, it was going to cause a big problem for the school. And so I was really good with numbers and building models and stuff like that. my foray into actual trading actually started with stocks. I had built a landscaping business and sold it and put some money into the market. I really didn't know what I was doing, but I was kind of cutting my teeth and learning the process. The commodity thing was just, like I said, I was in the right place at the right time. And I understood it a lot better because I grew up, in New York, you actually have a crop year. So I understood seasonality just inherently, and I could see that in prices. And so it just clicked for me.
Were you ever tempted to open up a commodities account and trade commodities?
Well, shortly after that work study program, I actually went to Wall Street, and I did. It was a little trickier back then because now it's like, man, anyone who could fog a mirror could basically open up a futures account and trade minis and micros. But the environment was very different back then. There weren't online brokerages. There were a couple of discount joints. Schwab was doing $30 for stocks as a flat ticket price. Kennedy Cabot was another one. Waterhouse might have been around before it became TD Waterhouse, before it evolved into TD Ameritrade. So I'm kind of dating myself. Mm-hmm. And you really had to prove financial wares. Like it was a hard process to get an account opened. You couldn't just walk in and say, hey, I want to trade. You had to show that you had substantial net worth and liquid net worth. And most futures margin accounts were not funded for anything less than $100,000. And you had to be there in person. There wasn't any, there was no internet, so there were no online applications. You could scan your driver's license and send it in, and within 24 hours, you're up and running, wire the money in, and you're trading. This was a 2 to 3 week process, and you actually had to pass muster and go through compliance. And there were a lot of people who got rejected. Now, I had very quickly gotten my Series 3, so they gave me, they gave me the benefit of the doubt, to let me do that. So I would say probably within 6 months of landing in my Wall Street job, I had a futures margin account as well as a stock trading account. It was all together.
I see. And what year was that?
That was in the late 80s. So 88, 89. Mm-hmm. When I started, it was post-crash, but still pre-E-mini. The S&P was a $500 a point contract. Margin was $40K. There was just very, very few trading opportunities. There were, sleepy little contracts. So I kind of had to learn how to, as they say, make hay when the sun shines. There weren't, with commodities, most markets aren't trending most of the time. So you really have to learn how to pick your spots and see what was moving. Gold was $200, $300 an ounce, to give you context. It was, it was a very different time.
And so how did you go about finding the stocks to buy, and kind of what was your early strategies?
I'm embarrassed to tell you, I really didn't have one. I was in an office with 70 other, financial advisors, and, a lot of it's like, well, what are you doing? Well, what are they doing? Well, and this and that. So it was the modern day Discord, what's in the newspaper, what's going, what can you, Peter Lynch style, like, what are the things that you see that you're using in your life? You're buying XYZ good or service, and then you kind of see, okay, where does it trade? You go to McDonald's, you go to Wendy's, you go, you're using Apple. It was called Apple Computer at the time. So all that technology was just coming online. Most people didn't have computers, never mind smartphones. Mm-hmm. So all that stuff was new. You couldn't really see it or touch it because it was also very my first cell phone, I think, was $1,000.
Wow.
And then it was $1 a minute for talk time. So it was, fantastically expensive, everything. So I just kind of tried to observe a lot, like what was going on in the world, what were other people doing, what were they watching? And then because commissions, I started with $5,000 grub stake in my trading account. For commissions on stock, it was $50. So that was 1% of my account balance. For commodity futures, for some reason they had two different rates that would automatically apply. One was like if it was a day trade versus an overnight, take it home, which is more my style. And that ranged between $75 and $100. So I was paying 1.5% to 2% of my account balance in commissions. So again, I had to think like a sniper, not like a sniper-like entry, but I had to sit and lay and wait for hours at a time, days upon time, waiting for trends to evolve and things to start to break out before I could put money to work. Because otherwise, I was just really churning my account. It was a very difficult time because I really was full of piss and vinegar and I wanted to learn. but the market's really there to take your money more than anything else. So I had to really learn the importance, which applies to today's marketplace too. It's like, if you can't express your edge, you have to learn the importance of sitting on your hands, and taking advantage of things that speculators really have a huge advantage of, and that is they have the right to not participate.
So with the commission rate so high, were you incentivized to hold the positions for a good length of time to try to maximize, squeeze out the extra profit out of it instead of, doing short-term trading?
Ian, that's 100% correct. Mm-hmm. My goal at the time was to grow my account to 50K. And I knew that sounded ridiculous, so much so that I couldn't even tell people, because they're like, listen, buddy, you don't know the backside from a hole in the ground. You think you're going to do 10X in your first year, trading commodities of all things at a time when the place was really a stock and bond joint. So I was more like, look, I know, because I could see the charting software was very, you almost had to do it by hand, but I could do the math in my head and say, like, okay, in the 70s, soybeans moved $5. That's $25,000 a contract. So I kept thinking, like, man, if I could just catch that and put the money to work and sit on it and live with the day-to-day fluctuations, then I could increase my wealth, because I was clearly in the wealth. I didn't have any room for error with 5K. I mean, you don't have it now. Back then, you didn't either. And they were meant much more like, think about AI and smartphones and technology and everything internet related and mobile technology. All of that didn't exist. So almost all of the names, except for like Apple and Microsoft, really weren't even trading, right? AOL was AOLN. It traded over the counter. And so you really had to pick your spots and be very judicious in your selection, security selection, and when you would put things on. But I learned, and again, environment really shapes us. I was grateful to grow up in that environment because it was so expensive to trade. I almost had to think, in buying and selling commodity futures, I had to think like an investor. And that has brought more gains and wealth than I probably deserved. Just learning to sit on my hands and not offset a winning trade, because I was so excited to have the winning trade in the first place. Let the winners run. I said, like, I'm worth it. I had to convince myself in my head, like, okay, a lot of it comes from my background. Like, I caddied golf bags at Wingfoot and Quaker Ridge. I worked, at mob-owned restaurants, and I made a lot of money. I would make $5,000 over the summer. I was making $5K a month back then, cash.
Wow.
And I'd always think, like, okay, I made $1,000 in trading. That would be like a week of golf, trade, working at the restaurant and this and that. So I had to get out of that blue collar way of thinking and saying, it's just the start. You're up $1,000. You're up 20%. I always wanted to think in terms of, the big thing that helped there was converting things into percentages, because the dollars were overwhelming for me. Because once I got to be 100% up, I was like, okay, that's the whole summer. And I kept thinking, because that was my reference point. But I thought, okay, well, if you're going to be up 200%, like the guys at Commodities Corporation, you have to have been up 100% first. So you can't panic. This is your big moment. You can't panic and do the small-minded thing and always live in like a make it and take it kind of mindset. You have to let your winners run. And that's what I learned to do. Thank God.
In your quest to 10X your account from 5,000 to 50,000, how tempted were you to use leverage? And did you?
Well, Your Honor, I'm guilty as charged. My whole point in putting the 5K in and going to commodities was for the leverage. I knew, because I was a math kid, like I could calculate numbers in my head. So I could see stuff. I'm a visual learner, and I could see patterns, not chart patterns, but I could see patterns in human behavior. I can just see patterns. It's something I was born with. And the math, my dad was a math whiz, and he taught me how to calculate numbers in my head. So I was a year ahead in math in school. I had passed out of a lot of classes that I would have had to have taken in math. And when I got there, I was like, okay, commodities to me are even better than real estate. In those days, if you bought a house, you'd have to put down 3K or not 3K, but 10%, and then you could finance the rest. Well, commodities were even better, because you'd put down somewhere between 2 and 5%. And you didn't even have to borrow anything because the leverage was implied, right? It was the margin deposit is considered a good faith deposit on the full notional value. So if you look at it with 5K under Regulation T, I could trade 10K of market value in equities for things that were marginable. For futures, if $5,000 is the number, and that's 5% of what number? That's 100K. So I could control 100,000 in notional value of commodities. So there was almost like a 10x. When I thought about notional value, under Reg T, I can control 10K. With futures margin, I can control 100K. Okay, well, if those notional values went up 10%, what was the value or the impact on my $5,000 grub stake? So I immediately gravitated to futures commodities trading with a strong understanding that with futures, you have unlimited loss potential regardless of whether you're long and short. So if you smell smoke, you have to assume it's a 5-alarm fire. There is no like, well, I'm just going to wait and see how things go. And that complicated things because, like I said, it was a $100 commission to get in and out of the trade. So I had to always fight my emotions. Like, I don't want to get knocked out of a trade that I could otherwise sit with through a small near-term pullback if the trend kind of still resumes. And that was really the hazing process where I had to thicken my skin.
How did you apply risk management back during that time and kind of what did it consist of?
Geez, you have done a lot of preparation. These are great questions. So I developed what I later kind of come to understand as progressive exposure. Now, some people call that pyramiding. It was more like, how can I add to my winners and steal second base without taking my foot off first? So what I would do is I'd buy like a sleepy little corn contract, or sugar is a better example, because sugar's never in the newspaper. Like, you'll never see a headline on the Wall Street Journal or Barron's or on Yahoo Finance where someone's talking about sugar. And that was perfect for me because I didn't want to get buried in what we called the Fab Five. And the Fab Five is an expression I borrowed from Michigan basketball. And that would be like the yen, the S&P, 30-year bonds, gold, and crude oil. Because those were the commodities that would get written about in the newspaper and would cause a lot of volatility. Again, remember, there's no internet. There's the C section of the Wall Street Journal. There's a business section of the New York Times, which nowadays basically doesn't even exist. Then there was Barron's on the weekend. So those media plays could really impact the price of a commodity. And I didn't want to wake up to heartache. So I would trade these sleepy little contracts that no one ever talked about: cocoa, cotton, sugar, this and that. And so what I would do is, as the market would move in my favor, and I knew I was going to be able to risk, say, $250 to $500 of my account, because I really didn't have a choice. I was underfunded. When the contract got up a few $100s, I would immediately put my protective sell stop at break even. Now, I didn't want to get knocked out, but I also didn't want to lose money. And so I honored that system really from day one. I just put in protective stops, and I've been doing it ever since. So then what would happen is like, if I added a second contract, I could see the volatility and say, okay, if it goes here, this is where I have to adjust my stop. So that even if I have several more contracts in the account, I'm still not risking any more than the original 250 to say 500 that I was risking on the original trade. So I kind of built in like free call options. It wasn't exactly free, and sometimes the market would come back and knock me out, and that was frustrating. But it was a way that I could sleep at night and live with myself and build into larger positions, so that when they did take off, that's kind of how I made, several $1,000s on a trade. It was not because I had one or two contracts risk on, risk off. It's because I kind of unknowingly was pyramiding into things, but very strictly managing the risk, not taking on more risk. 30-40% of the time, the markets would continue to move in my favor. And then I was making really asymmetric returns for the risk that I was taking, which was the whole point. Because I knew the math. I knew enough about playing poker and blackjack that this was a game of expected value, not about accuracy per se, or being right all the time. And I could emotionally live with that. I was good at, I didn't have a problem taking chances.
So how did you decide on when to get out? Like, what did you have a system or a target to tell you when time to exit the position that has moved in my favor all this way?
Chat with Traders is sponsored by Plus 500. Trading futures might sound complicated, but here's the thing. Everyone starts somewhere. Plus 500 futures could be your first step. With Plus 500's powerful platform, you can access a wide range of markets: S&P 500, NASDAQ, Bitcoin, natural gas, Forex, metals, crypto, and more, all in one place. The platform is simple, intuitive, and mobile-friendly, so you can trade from anywhere, anytime. Open your account with Plus 500 and start trading with as little as $100. You don't want to risk even a penny? I understand. Plus 500 offers an unlimited, risk-free demo account packed with real charts and tools to help you practice and build confidence before jumping in with real money. With over 20 years of experience and over 30 million global customers, Plus 500 is your trusted gateway to the futures market. Visit us.plus500.com to learn more. Trading in futures involves the risk of loss and is not suitable for everyone. Not all applicants will qualify.
You know, the honest truth is, and I'm red-faced, even though people can't see it, like I didn't have a strategy on how to exit winners. It's probably the hardest trade, I think, even today for people alike. It's like, when do you know when the move is over? And you really get to operationally define that yourself. So what I did, because again, I'm self-taught, you know, so again, this is, you're going to laugh, but I didn't have anybody to show me. Like, the guys that I eventually met who mentored me when I became a pro, you know, were obviously already very, very successful, but there wasn't someone to kind of say, hey kid, when this happens, there was no 50 or 200 day moving average crossover kind of system like there is in stocks. There wasn't like a Dow theory like Victor Sperandio uses, you know, for equity risk management. So I had to do it by the seat of my pants. And the simple answer, Ian, was, I thought by putting, every day I would put the open, high, low close in and then mark to the market where my equity was if I had, say, 3 or 4 contracts in the sugar or the corn, and say, okay, at the open, I was up 30 ticks, and this is what I would have been. Because I wanted to calibrate my system to not have this hair trigger response to knock myself out of winning trades just because I was up big at the open. Mm-hmm. So I went through these case studies of looking at other moves in commodities and saying, okay, if I had my proper risk management on risking, say, you know, depending on where my equity in my account was, you know, between $250 and $500, you know, per trade, could I live with these types of drawdowns, knowing that the trends would persist eventually because of forces that I might not have even fully understood? So, you know, I just tried to stay with the winners for as long as I could because I knew I wanted my money to work for me. Later in life, so I kind of did it by saying 250. I have a $250 trailing stop on my equity at any given time. That was how I did it in today's language. I didn't know it at the time, like that's what you called it. Like, who knows what the hell trailing stop is? But that's effectively what it was. And if I was really making money, you know, and I got to like 6, 7, 8,000, I can remember giving it a little bit more room because now I wasn't losing my corpus. I wasn't losing my original grub stake. It wasn't house money, but I was willing to go a little bit more aggressive because I was then risking money that I had already earned from my trading activities, right? So I always look at it as my money. It's always my money. It's not house money. But I still do that today. If like my equity is up, I tend to trade larger when I feel like not necessarily I'm in the zone, but if I have the P&L to prove it, then I can afford myself more risks. I go back and I do this case study and say, okay, how much of this am I willing to risk in order to stay in the trade? Because the odds change, Ian, like once you're in the trade. It's like that old Monty Hall thing. Like if they show you what's behind door number 1, this and that, and there's a whole science around it. When you're in a trade, you know, risk on, risk off, you might have like a 3-to-1 payoff with 40% accuracy. So you know your system has positive expected value. But what you learn over time, and this took me a couple of years to learn in studying the data, is that your odds might change. So now you have to use conditional probabilities or Bayes' theorem to say like, okay, I'm up X percent in the trade, or it's moved this amount. What's the probability of event B, like the move continuing up X amount, given the known probability of event number A that I have a 40% accuracy and a 3-to-1 payoff? So you can really apply that math to make better decisions. It's not probably for beginners, but it was math that I could understand because, like I said, I was a math guy. And then the light bulb kind of went off and said, see, this proves my theory that I should stay with winners, even if there is going to be a pullback, because the math supports staying with the trade and then maybe even adding another contract or another 50 shares or something at that point, because the probability might be like, okay, you have a 5-to-1 payoff with a 30% accuracy. So the expected values change over time. It's not static.
So over time, as the technology develops and technical indicators are introduced and become easily accessible, did you zero in on a few technical indicators that could easily replace your mathematical thinking, so that you wouldn't have to crunch those numbers?
I did. And again, I'm red-faced about it because I failed at all of them. They never really were worth all the binary code that's used to write them. In the book, I call them emotional band-aids. And that's really what I looked at them for. Like, can I increase my sense of accuracy by using indicators? And they're not really indicators. I use that term with you, but I think of them more as validators or confirming indicators, because anything that you need to see about whether the trade's working out, you can see in the damn price of the instrument itself. So ADX, well, great. You're never going to see ADX like is one that I've studied. And yes, you can see trends emerging or the strength of a trend emerging once it starts to come out of the 20 to 25 range and kind of trade up above 25. But you're never going to find a strongly trending market that doesn't have a high ADX number already, right? You could look at MACD. There's a lot. So I just looked at all those things and I said, why am I doing this? Like, what is it intellectually that I want? And what do I want out of it from an emotional and psychological standpoint? And I realized after, 2 or 3 years looking at all these newer prefab indicators that I was really looking for some kind of emotional security, and it doesn't exist. There is no, external solution to the internal things that you're feeling. And I don't want to layer up my charts with these things because it just doesn't work. They can only kind of confirm things that you can already see on the chart or that you can see in the price. Very few of them. Like relative strength for stocks can matter. You can use ATR to normalize risk in the commodity markets. That came out in 1978. So that had already existed. I didn't know about it, again, because there wasn't an internet and I hadn't seen Wells Wilder's, book. So the answer is yes. I tried to uncover every stone, but I found that the efficacy or the value that any of them would bring wasn't going to help my profitability. It was more to calm my nerves. And that even still didn't really work.
During this time, did you say you were working on Wall Street? The trading obviously became a passion of yours, the way you're describing it. But did you ever envision that trading by itself would eventually replace your actual jobs, or were you trying to get it to replace your jobs?
Yeah, great stuff again. Without getting into the whole history, which, I'm more than happy to get into, I was a working class kid. I was a day player. I'd go to the golf course and I'd go home with a pocket full of cash. I'd go work at Glen Island Casino and I'd come home with a bunch of cash. And I was used to being a day player. And, my parents were Depression era. And so we had enormous amount of grit. We were hardworking people. Like that was the culture that we grew up in. A lot of Irish Catholic, Italian Catholic people who left the city, wanted their own piece of property and, instilled in their kids, put your head down and make something of yourself. So when I first got to Wall Street, it was really, I wanted to be several months ahead. When I left, I had $1,000 a month rent. I had, $1,000 a month go to student loans. And that's before I had any food, dry cleaning for my suits and all that kind of stuff. So my goal at Wall Street was to learn intellectual property. I wanted white collar. I wanted to stop exchanging my time for money. I was very clear about that and what did I do? I went to Wall Street and I was working 15-hour days, putting in blue collar hours on a white collar job, which is what you do because you don't know. I didn't know anything else.
Did you like your job?
What's that?
Did you like your job?
I did not. I didn't like it. I wanted to get a trading job, but in those days, I actually hated the job. The people were okay. I met a couple of really good folks who I'm still in touch with, but they were financial advisors and they made the mistake of thinking of themselves as Peter Lynch. Like just because you have a Series 7 or any other type of license, that just allows you to do marketing. It doesn't really teach you anything about creating alpha. But people start to think like, hey, I got access to because in those days, again, there's no internet. So there was a club. And if you didn't go to one of the 5 or 6 big bulge bracket firms, the brokerage firms, you were out of the market because there was no other way to get entry. Now it's like you could do it on your phone. You could trade for free. That's a complete culture 180 from where I was raised. So I was like, I'm just as good as any of these people. They all think they're smarter than, everybody. But I'm just going to grow my capital so that I could replace, I figured, look, if money markets were paying 5% in around 1995. And I remember them saying like 5 and 5 and 95. And what they meant by that was the Dow was going to hit 5K. Interest rates were going to be 5K, money markets, right? And that was all in 95. And my thought was like, I don't know how the hell I'm going to do this, but I'm going to put myself in the energy of having $1 million at 5%. That's 50K or 4K a month. And I could pay my bills and have money to enjoy my life. Not a spendthrift. I didn't want a Ferrari. I didn't want any of these. I don't buy stuff. I didn't want to accumulate goods, especially things that are going to depreciate. So I just thought like, how could I grow my wealth so that my money can finally work for me, right? You either work for your money or your money works for your money. And I had no experience. I was a complete virgin in that area. So I had to teach myself because it wasn't in my family, in my nuclear family. There weren't really any investors. There were some well-educated people, but they weren't really investors. They were savers and workers, and they had pensions. And that's not what I wanted for myself. So I knew I had to grow my capital. My Clark Kent job, though, was being a financial advisor. So you can imagine I was really I was a double kid, like they said in the department. On the weekends, I would drop my R's and sound like I'm from Dorchester and Charleston. And then, during the day, I'd be like, yes, let's talk about the confluence of religion in the Middle East and its effect on your eleemosynary concerns. And I'd become a completely different guy. So I didn't like that part of it. I didn't like to have to fool anyone or do something that, try to be somebody that I wasn't. But, the branch managers were looking at, they didn't grade you on profitability. They graded you on how many new accounts did you open, households, new accounts, what were your net new assets that you brought in that either existing clients gave you or that you brought into the account, transferred in, and how much did you generate in commissions and fees? Nowhere in there was like, if you made money for the client. And I knew that I was going to be an alpha generator, and they were not concerned with alpha generation unless it added up to their commissions, because that's how they got paid. We had the whole floor, and I'm sure the rent was $100,000 a month back then. So, I didn't like that because I wanted more. But it was the only way I could get in. It was if they don't let you through the front door, you go through the bathroom window kind of a deal. Well, that was kind of how I did it, because I figured from that perch, I might be able to move horizontally. Like at least I could learn how the business is run. Before that, I was looking from the outside in. I said, let me get into the business and then I could move around. It was a lot harder than I thought it would be, because they kind of pigeonhole you. And in those days, they weren't, don't laugh. They were hiring traders on the desks if they had MBAs. And I was like, that's got to be the stupidest thing that they ever did on Wall Street. But that was how they cut the pile and culled the herd down to keep the interview process. So I had no interest in getting an MBA. I like knowledge for knowledge's sake, but there was never any proof that having an MBA was going to help you be a better sales trader, market maker, institutional salesperson, or prop trader at like a Bear Stearns.
Did you ever meet any of these MBAs and get a chance to learn what the traders are doing in the firm, maybe get some ideas from them?
I did and I didn't. I got to know a few of them because I was trading enough size that I could call to the traders and the market makers and negotiate better prices. Because again, in those days, the spreads weren't decimalized. Decimalization had not come to pass, so everything was trading in eighths. So, if you could find, in those days, there was something called 19C3, where you could take a New York Stock Exchange listed stock and trade it like it was over the counter. So I remember, buying Wendy's quick service restaurant that was quoted 16 bid, offered at a quarter. But if I could buy like 3, 4, 5,000 shares for my own account and for my clients, I could call the market maker and negotiate them to get a better price. So I'd fill the trade at an eighth and to put an eighth commission. So I'd be in for 16 and a quarter net. My clients would love that kind of stuff. So I learned how the game was played because they had a P&L, which was based on the spread. I had a P&L, which was based on my commissions and fees, which was completely backwards on doing the right thing for the client. But that was the game that we had to play. And I did that for 3 years of finding things that had different, spreads that they were moving, and then using my institutional size to negotiate better prices. They didn't really teach me how to make money. They taught me about how to ungame the system to benefit the client, because they were not really prop traders the way, say, like a Lehman Brothers or Bear Stearns were, right? So I applied to all those places because after 3 years, I had the track record, but they were still in the mindset that they wanted to hire you coming out of business school or sponsor you to get an MBA. And I was too smart or too stupid to lie to them. Like, I didn't want to get an MBA that had nothing to do with trading. To me, it was like, I have to put now 2 more years as a buffer between me and my goal. Like, that's not going to happen. The interesting thing was that, to a name, like, most of those companies are out of business except for like David Shaw, Long-Term Capital. I'm sure I had caddied for John Merriweather at Wingfoot. Sent a cover letter resume with my track record, with documented track record. And, I don't think I got a call back. Like, I was just completely shut out. So I started my own company, and that's what I did.
Interesting. So you quit your job there on Wall Street and you started your own company doing what exactly?
I feel like Paul McCartney here. There's no short answer. Just, again, I was in the right place at the right time. You have to remember, in July, I had a lot of clients in Chinatown because they really liked the action and they liked to see money being made. And I was getting really good at trading commodities. Long story short, I was in the right place at the right time with the right people, not mentioning any names, who had a big impact on delivering the Chinatown vote to Mayor Giuliani for his first term as mayor. And I helped those people because around July 1st of 1997, Hong Kong was going to go back to being China controlled from the UK, right? And so there's a lot of people from Kowloon and a lot of Hong Kong folks in Chinatown in New York City. And they were all scared. So they wanted to get their money out of Hong Kong because they thought that China would close the border. So we called it political flight capital. And because I had done a good job making relationships with these people, and perhaps because I wasn't involved in like organized crime or a tong, and I was at a big kind of not a gumshoe, but I was a white boy, right? I was a white boy, and they was at a reputable firm that they could trust. So all that capital came to me. Then I made those people money in commodities. So when I said, look, there's no vertical or horizontal movement for me here as a trader where I could do an even better job for you because we could cut commissions by 90% on the institutional side, I'm going to go start my own company and work under a 2 and 20 structure. And I realized, like, if I did that with the money that I had made my clients over the past few years, I would have done 6 times the gross commission that I did. And that all would have been mine. So I figured so I left and I took about 15 million worth of clients' assets in a 2 and 20 structure. And I really haven't worked for anyone since.
Oh, wow. So during this time, as start of the .com boom, were you tempted to get into stocks as well, or were you strictly commodities?
I'd probably say 3-to-1 commodities to stocks. The reason being was you have to pick your poison. Look, Paul Tudor Jones could probably trade any asset class on any time frame, right? I was developing that skill, but I was still a super sophomore. I knew sometimes what the right things to do were, but I'd find my way doing the wrong thing anyway. The saving grace was that I always kept my losses small. I knew I did not want to go into protracted drawdowns that would crush me emotionally. I didn't mind losing the money, but I didn't want to be in a 20% drawdown needing it, because then you put a lot of pressure on your money, right? 20% drawdown, you need 25% to come back. That could take you 2 years. Like, I don't need that crap in my life. And what I didn't want to do is I kind of understood the technology. I understood things were trading. I was just getting my first email account on Sprynet and Mind Valley or whatever, MindSpring, excuse me. And I didn't want to tie up my cash in stocks because of Reg T. when I could do 10 times more notional value with futures margin. So it was more an allocation decision to run a CTA. I was probably running concurrently an RIA as well for the stock side, but also the profitability. Like if you have $10 million and you make 20% and you're getting 20% of that, right? So now I'm getting 400K. It was harder to do that with stocks without taking super gigantic positions. And I didn't want to do that because I knew if I was onto something good and I was finally living, not the dream, but I was becoming the person that I had envisioned of becoming. I was a white collar person using my brain, managing risk, keeping losses small. And I knew that if I screwed that up, that I could be back at the golf course next week. And that was a big motivating factor to not necessarily to have to eat crow, because I never had that kind of ego, but it would be just such a complete personal failure to have this thing blow it, get so close to the promised land and then blow it up and then be relegated back to waiting tables, which, look, you work hard, you earn money. There's nothing wrong with it. I made a fortune waiting tables and caddying golf bags, but then I wanted to evolve.
Over the years, did you calculate kind of what was the minimum percentage annual return you would need to have when you were working for yourself to meet all your expenses?
I did. I know, because I still to this day, I have this gigantic Google spreadsheet that literally has every number mapped out. Like, what do I spend on Calendly every month? Like, what do I spend for premium Spotify? Like, I know my numbers. The good news is when I left the brokerage firm to set up my own CTA, I started with 12 and then another 3 came over time because the people wanted to think about it and all this and that. But eventually over the next 6 to 12 months, that money kind of came. So I had a full 15. And for some of them, I cut breaks, but I was earning between 1% and 2% as a management fee. So I really didn't have to sleep with one foot on the floor and worry about paying my bills, because I'd have a couple $100K come in, to handle my finances, which, I had earned the right, to do by doing a good job with those people. And also because I was, I cleared ED and F, man, they were charging me, it's a lot by today's standards, but I went from paying, say, $90 to $100 to $10 round turn. It was like a 90% discount. And everyone loved that because they definitely were aware of the commissions they were paying me when I was an upstairs, guy at the wirehouse. So I did think about it, but it wasn't a concern. My biggest concern was not getting into or having my big thing is I'll never be in a 10% drawdown. If I smell smoke, I'm going to puke it out. And I'll even call the people and say, look, I'm going to take a month off because the markets are not amenable to my trading style, but I won't charge you the management fee. I was very good at communicating with people. If they had to hear bad news from before Kramer, is a guy named Dan Dorfman, who was kind of like the carnival barker for the markets. He's just one man's opinion, and I get it. He's an entertainer, but both basically kind of useless. And I figured man, because Maria Bartiromo was just kind of coming online, and CNBC was evolving and this and that. And I didn't want my clients to have to hear the bad news from the TV. I had to be the person in control of the relationship. So I spent a lot of time communicating with people saying, it looks like this could set up. If it does, here's what I'm going to do with gold. Here's what I'm going to do with crude. Here's what I'm going to do with the Deutschmark, blah, 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 blah. And if it doesn't pan out or you don't see the confirmation come through, it's because it turned out to be a suboptimal, opportunity. And I don't want to throw good money after bad, because what we don't lose, we don't have to earn back. There'll always be another opportunity. But if you put yourself in a bad spot, drawdown wise, you lose your confidence, you lose your nerve. And that's the last place you want to be as a trader. I don't mind losing the money. I don't want to lose my mental edge. The mental edge is the whole thing.
I see. We'll go more into detail on that. What are some of the common mistakes or common mental edge issues that you faced early on, and how did you overcome them, or how did you minimize their impact later on?
You honestly are a great interviewer, because you're not giving me any room to breathe. Like every question, yes, Your Honor. Yes, Your Honor. No, Your Honor. Like I am absolutely testifying here. So again, I was in so much fear about money. Like, even though I was starting to get financial abundance, I didn't trust it because I had never had it before. All I knew was going to work, shave my face, put on a tuxedo, wait tables, and this and that. So when I started making money, I had trouble trusting it. I was afraid that it was going to go away. And I knew that it would have been my fault. Like, I had enough self-awareness to know, like, it's not going to be a market correction that puts me out of business because I don't have that type of risk on, right? We're carrying, over the years, I got much more aggressive in the mid 2000s, but in the mid to late 90s, I would go home with maybe 10% margin to equity ratio, which is kind of like where the CTAs kind of live. When I got really, really good and I had over 10, 15 years experience, when China was buying everything in the mid 2000s, I'd have 70% margin to equity. Like, I was levered up. I was taking gigantic, big 5-figure numbers out of gold and copper and sugar. I caught the sugar move from 9 to 18. So mental errors were, don't get haughty, don't get full of yourself. This has nothing to do with intelligence. When I went to Wall Street, I had teachers who had Nobel Prizes. So I thought I was going to go in and trade every asset class, every time frame. And all I did was lose money and prove that that doesn't work, not at least at the beginning. So I said, I just have to stay in my lane. I have one skill. I understand commodities. I never would have guessed that was, and I was an utter failure at foreign exchange. Plus, I hated the fact that it was 24/7, and you basically needed a Bloomberg. And I couldn't afford a Bloomberg. And still to this day, I wouldn't pay $2,000 a month for 2 years to have access to data. It's just not how I'm built. Options were very clever, but there were so many moving parts with Vega and Charm and Theta and implied volatility, historical volatility. It was too much for me, given that I had my Clark Kent day job where I had to look and smell and feel like a financial advisor and kind of be a closeted Superman trader, and so the hubris, pride is said, it's been written, pride's a big banana peel. I couldn't fall in love with my P&L. I would never sit and bask like I've got a gigantic position open where, you could have $250,000, $300,000 of unrealized gains. For a blue collar kid, when you started Wall Street, that could have been like 3, 4, 5 years of total compensation pre-tax, right? So I had to forget that thinking and just saying, okay, well, if you have $10 million, $12 million, $15 million, and you have a $300,000 unrealized, you have to think percentages to give yourself context. So that really helped, was to stop thinking in terms of dollars and cents and okay, I lost $10,000 on a trade, big deal. That would have been like a whole summer or 6 months of working in my blue collar jobs. Then coming to understand that intelligence is important, but it's not how you make money. Making money is about knowing good trading tactics, and can you pull them off? Do you have the will to do it? And I was afraid. I was absolutely petrified because every time I put on a trade, I felt like kind of like I do now, like I'm on the witness stand, and that you have to pass muster every day, and you kind of do. But it's not because you're smart or stupid or you're lacking something intellectually. Trading is about adding risk with an appropriate dosage. What is your risk unit? Like, coming from a hedging, being physically trained in commodities, you know what your needs are. So you hedge for your needs. But when you're a speculator, you don't need anything. So how the hell do you figure what the right position size is? That I had to carve out of stone and figure out for myself. And when I lost money or more money than I had wanted, it was very, very hard on myself. And I said, okay, but trading is like sex in many ways, or other things in life that is largely experiential. You can read about it and study books, and God knows I've read every trading book that's out there. I still have them. I've got, first editions of Edwards and McGee for stocks. I have Chester Keltner's book on, how to make money in commodities, which is the actual title. And those are all interesting. And obviously Market Wizards had an enormous impact on me, but not because of how they made money, just because they were regular people and I could identify with them based on the feelings that they had to feel when they were learning to develop their craft and cut their teeth at this.
So could you go into a little bit about your strategy? Kind of how did you trade? What did you specifically look for? Presumably just in the charts, assuming you're not, were you doing anything with fundamentals at all? Looking at reports or, commitment of traders reports or anything like that? Or are we just looking at the charts?
inside the wirehouse, I had access to research reports. But what I learned was that the research reports, the way that they were written, were really just compliance approved data points that I could use to speak with clients to get them to do trades to generate commissions. It wasn't really about the accuracy of the report, because crop reports change like the wind. Sometimes there'll be a seasonal dislocation, or there'll be a blight, or in some of the grains, especially physically settled commodities are seasonal and can have those types of disruptions more than, say, currencies or cash settled, commodities, in my humble opinion. So I did read everything I could get my hands on to learn the vocabulary and the vernacular of the space. I did, like I say, have friends. And so this has kind of never been disclosed before. But when I set up my CTA in New York and registered as a commodity trading advisor and became a member of the NFA, 2 or 3 times a week, I would go to the floor of the various exchanges to meet with the people who were actually dealing with the physical commodities, because they're the ones who have all the information. Mm-hmm. They're actually involved on the physical side. Now, again, I was physically trained, but I would go to the floor and I would stand by Man's ED&F Man. They had seats on every exchange. And so I would stand by their post and learn, like, what was the crowd doing? When were they, where were my levels? What were the inflection points? Where were we at daily highs, weekly highs, monthly highs, life of the contract highs? Where were we in the history of things? And see how did they behave at those inflection points? What kind of volume? What kind of how would it change open interest? Mm-hmm. And then calibrate that and kind of market to the market to see if I could incorporate that into my decision-making process. Because there is for example, if you see, this doesn't work for equity people, but if you see like a commodity going up in price and volumes steadily increasing, but open interest increasing, you can ascertain that it's probably new longs that are coming into the marketplace. And being a smaller speculator compared to the bigger people of the day, I always wanted to be buying when there were other buyers, because I knew that they had the money to punch out my lights, and they would also come back into the market perhaps and even support their existing positions. That would give me buoyancy for my smaller little positions, which, they seemed big for me. They were small in the context of the overall market. But on any given day, I'd be down at coffee, sugar, cocoa, and cotton. I'd be at Comex. I'd be at NYMEX. And I'd be trying to execute my orders kind of from the floor and just giving the orders to the clerk, right there, because they would bring me onto the floor as a guest, which you could do. You'd have to wear a suit and tie, leather shoes, and shave and look. You couldn't come in looking like in cargo pants and flip-flops. So you'd have to dress. You'd have to dress neatly. But my friends would bring me on as a guest, and I would stand, politely out of everybody's way, and then watch and see like where was the action. And then if gold kind of closed down, I would go to Comex, or trade copper or silver. I'd look and see, okay, is there anything going on in energies? But rarely a week went by from 97 to I moved to LA in April of 98, that a week went by when I wasn't at one of the floors, like learning that. Not just how they behaved, but also the culture. Like, it's really sad for me when I reminisce about that culture. Like, there were some great little things and traditions that they did. I remember being on the floor in natural gas, and one of the guys who was a longtime local died. And when you're down there in the crowd, you're fist fighting with people, but there is a type of brotherhood. Like, they love each other. They really love each other. Like, they're in this together, and they are competing, but they still love each other. And one guy who was a local, he died. Mm-hmm. And I remember it was very emotional for me. Even as I think about it, they shut the exchange.
Really?
For a moment of silence. And they held the guy's picture up. You're never going to see that anymore. It was very remarkable to see.
Huh. Did that feel like kind of like a second family to you, given?
Absolutely. Yeah, absolutely. Because yes, they wanted my clearing business. And I kind of had a reputation of becoming a younger Turk, but it was more like, it's good for the business if the young guys make it and become the next wave, right? We don't need the stories of Gibson greeting cards and Mattel Gesellschaft and these other guys taking on these big positions and getting crushed. Like, it's not good it's why Lucky Luciano put together the Mafia Commission. It's when you kill people and they find dead bodies, the cops get involved and they start investigating. So we might as well decide to have peace among us and determine things behind the scenes so that we can all make money, right? And not draw the attention of the cops or the FBI. And I'm not saying that you should go, go do this, but the the clearing member community and the floor traders, they're not jealous. They are competitive, and they might take your success as an input to go out and succeed more. But it's good for the business when the young people come in and succeed. Right? Mm-hmm. Because it's hard for some of these larger places. They can't trade, for example, smaller markets because they're too big. They're beached whales. So if you look at like the softs, coffee, sugar, cocoa, cotton, there's certain points where these entities that run $50 to $100 billion, they can't really trade those markets, because even if they bought the exchange limit that you can buy, it wouldn't move the needle on their bottom line. Plus, it would still give them enormous amount of risks. So young guys like me would come in and say, look, I got 20, 25 million now, and I could very regularly trade, a methodology, short-term, intermediate-term trend following stuff where I could catch those moves and provide additional alpha to you.
So what would you say were the top lessons you've learned from your biggest trading mistakes, and how have they shaped your approach?
Hey guys and gals, it's Tessa. Sorry for the interruption. This is going to be quick. These interviews take time and dedication to do, and honestly, we hardly make any money from it. Enough to cover expenses of running a podcast, though. But we do it because we love contributing to the trading community, and all we ask from you, our dear listeners, if you love Chat with Traders, please be generous and give us a like and subscribe to our channel and tell others. This can be your way of letting us know that you love the podcast, and so that we can keep it going on forever. No, just kidding. Not forever, but for as long as we can. On behalf of my co-host, Ian Cox, and I at Chat with Traders, thank you so much. Now back to the show.
The biggest mistakes came from ignorance, and it wasn't not knowing like what type of, soybeans are delivered against the contract at the Chicago Board of Trade. That's all kind of interesting, but you can Google it and see for yourself. It was more like conjugating my emotional intelligence and who I was as a person with the tactics that I knew how to pull off in the marketplace. Those were the biggest evolutions for me. And I knew that you can't really paper trade this stuff. You really have to learn how to calibrate. Because again, I'm coming from blue collar despair. I grew up in a Raymond Carver short story. I loved it. It shaped who I was. Like I don't regret any of it, but environment has an enormous impact on who we become as people. So I spend a lot of time, who do I spend my time with, and what kind of things are we doing? And I learned that, again, intelligence doesn't necessarily matter to the extent. I'll give you an example. There was a guy who I worked with at the Wirehouse who I really loved. He was not a bright guy. He was like, hey, how you doing? He was from East New York, which is a very tough neighborhood in Brooklyn. At least it was in the day. And he had been a paper salesman. He would walk around the streets in New York in the middle of the summer with reams of paper on his shoulders and sell it to businesses. Because this is like, now we just go to Staples or you go to Amazon, you order to come to your house the next day. That didn't exist back then. And he did regularly $100,000 a month in commissions and fees, but he couldn't put a sentence together. Like he could barely put a sentence together. So I learned humbly that in Wall Street, we don't get paid to know stuff. We get paid to execute. And I had, because I had done well in school, I had let myself kind of get over my skis and be like, there's often times when I'm out with friends or family where I'm the smartest guy at the table. Well, guess what? No one cares. It's the most wasted amount of energy that you can spend on yourself is to sit about thinking about your designations and your degrees. Sure, you can be articulate and have a great vocabulary and explain complicated things, but it doesn't necessarily mean Again, if you're a PhD in finance and you're doing high frequency trading, yes, there's programming skills that you need to have, this and that. But for discretionary traders, you get paid to execute. And that means, can you keep your losses small? The second thing is I can't manage risk today, Ian, based on what I think or anticipate could happen next week. Because the reality is, ex ante, if my protective stop is hit, I'm getting knocked out. I'm dealing with conditional probabilities of what could happen, woulds and coulds, for next week. And that was, the experts are saying this is showing up in the newspaper, that, and there's supposed to be tightness in supply. So I'm just going to stay with the position and stay in a losing trade or something that's giving back too much longer because I think things are going to improve. We live in a paradigm of personal responsibility. That's number 3. If I make money, I get to take credit. If I lose money, it's no one's fault but mine. I cannot blame anybody. I can't blame, you've been around for a while, Abby Joseph Cohen or Elaine Garzarelli or Mary Friggin Meeker or, anybody from Jerome Powell or Dodge and Elon Musk. Or if I add and remove risk, that's my responsibility and nobody else's. And if I lose money, or if I'm like, I'm down a little bit, but it's not quite where I'd feel uncomfortable, I'm just going to see how things go. That's killed more traders than any other statement in the world. So responsibility, it's yours. If you don't have it or you don't want it, consider not trading, because you're going to lose more money than you could ever damn dream of with a lackadaisical attitude, or be like, I'm going to just take credit for the winners, but the losers are going to be somebody else's fault. That dog don't hunt. You're going to get killed. You're going to get absolutely killed. So I learned to be decisive. Your traders have to be decisive.
How often have you encountered traders, even including yourself, who are in a small losing position, but then they start to, look at the fundamentals or the news, and they say, oh, well, this new news information, it's actually bullish. And so I feel even more confident about holding on. It'll bounce back. My position will bounce back because the news now seems to be better than it was when I entered the position. So if I put in a stop loss, or if I get out now, cut my losses short, I'm going to be missing out on the big rebound.
So, another really, really good question. What we're looking for there is convergence and divergence. And I talked to Michael Marcus about this a lot, in that if really, really bullish news hits the tape and the price doesn't move, there's a couple of things to kind of reconcile. Was it the hype? Was it people selling newspapers? Was it something that because again, the physical people, the folks who actually have the commodities, they know everything because they're in the damn soybean or cotton business. And so for them, it might not be news. It might be a news story for the public and the small speculators. But what you're looking for there is I think, I think he's been on the show. My good buddy, Brian Shannon would say only price pays. Separately from him, I kind of coined a phrase that I used with my clients from very early on, and that on Wall Street, only price will tell you the truth, because everyone is selling something. So there's kind of that part of it too. But if bullish news hits the tape and the price doesn't move, I'm absolutely going to probably adjust my stop higher, or at least be mentally prepared that I'm probably going to get knocked out of the trade. And the converse is also true. If really bearish stuff is supposed to hit the tape and the price is kind of still moving higher, I have to trust the price. But all the while, I'll have a protective stop. I don't try to overthink things. Ultimately, if the data that you mentioned is so important, it's going to be reflected in the price. And if the price doesn't move, now we have a divergence. And that's the point where you focus on price. You can't fall in love with NVIDIA or AI. Trump got in office and Bitcoin went from 107 to 77. How's that feeling for you? We're going to have a sovereign fund, but we're not really going to put taxpayer money to work. We're just going to kind of confiscate the stuff from Silk Road and keep it. Well, that's a whole different demand equation now.
Doesn't this point to the idea that we should not be paying attention to news because we can easily get swept up in it and it affects our decision-making ability? And we say, oh, but this is the biggest bullish news I've ever seen, I'm going to hold on, rather than just simply let the charts and price action tell you what's going on.
I mean, God has spoken those words. I agree with you 1,000%. You can't get tied up in the story. Dude, she likes me. She was texting all her friends. Well, that's what she said, but she might be doing that for 3 other guys. She's swiped right quite a few times. You know what I'm saying? So I can't fall in love with my P&L. I don't fall in love with charts. It's like, show me the money, because it's price action, and it either shows up or it doesn't. And you have to be object. Look, I'm the first guy to get very aggravated if I get knocked out of a winning trade and then have the thing revert, but I'll just always buy back in at higher prices. Like, that doesn't bother me. I don't look at like, well, I really want to fall in love with this trade, buy sugar at 17 and sell it at 75. Well, I might get knocked out and be in and out of the trade a slew of times to catch chunks of the move. I don't have to have it be, if you invested $10,000 in McDonald's in 1965, you have more money than Jesus. Well, that's great, but $10,000 in 1965 was an enormous fortune. Most people didn't have it. So you learn to also have a discerning ear. You can learn to hear money. If you missed the 10, best days of the stock market, here's what your returns would have looked like. But what they don't tell you is that things like that happen in clusters, and the 10 worst days were also close to the 10 best days. So you'd have to have the worst damn luck of any human being who ever put money to work in the market to only miss the up days and not miss the down days that kind of went with it. And if you look around September 11 or what happened when we all got 2020'd, when COVID hit the tape, you can see the best and worst days kind of happened in clusters, right? So there's a long-winded way of answering that question. You have to stay out of the news and learn that your job as a speculator is, in single sentence, is to play superior defense. I don't believe the winners take care of themselves. You have to show up and win, and you have to know what your appetite for risk is. But if you're going to try to do this in any asset class, the goal is to keep your losses small. Focus on playing defense. You want to think about being Lawrence Taylor, not LaDainian Tomlinson, the other LT, or whoever the big running back is of the day.
Great. So to wrap things up, is there anything on the horizon lately that excites you?
Yeah, I mean, I think, certainly fundamentally the stories of the day with, not Fartcoin and that kind of gimmicky meme stuff, but I do think there is probably some promise in and around some of the crypto things like, Cardano, Ethereum, certainly Bitcoin, and having a codified body of law like we had in the 34 Act in the 1940, the 33 Act, the 34 Act, the Investment Company Act of 1940. You had, SIPC, and you also had, ERISA. All of those landmark types of laws that were codified, they give everybody a level playing field, right? So I'm not Joe Crypto, but I like the idea that for that space, the regulatory environment seems to be kind of coming of age, right? So that's a good thing for the market. It's good for people. It's good for investors. I like the idea of, we're still very early in AI, in that most people, if you talk to them on the street, and I know that doesn't sound scientific, they can't tell you where AI shows up in their life. They know if they are on a website and they're having trouble, they have an AI bot, and that's the extent of it. So I'm excited to kind of see what that brings to the table. But the stuff that I do with Victor Sperandio, our strategy has a negative 66 correlation to the S&P. And it just brings into sharp relief that diversification is absolutely important for everybody, whether you're a trader or an investor. And, those are all things that you can determine before you even put money to risk is what are you going to trade? How are you going to trade it? Know yourself, put some time into knowing yourself about how do you feel about making and losing money? How do you feel about being right or being wrong? Being right, making money, losing money, being wrong. Like, it's not a reflection of your intelligence. It's a function of being, having good luck and good timing versus bad luck and bad timing, so there's a lot that goes on there. I'm excited, for people to kind of focus on that and learn about themselves, because if you don't know who you are, I don't think it really matters too much what the hell you know, because you're never going to be able to turn that into money. And as trading is experiential, the best trader coach is you're actually doing the trading. And that's coming from a guy who's done some consulting and coaching on the side, right? The best way to do it is to just say, do it. I'm going to risk $100. And that's how I'm going to learn my craft, because that'll calibrate who you are with what you know how to do for that period of time in your life and get you going towards the results that you think that you want.
Well, these are great wisdoms you've shared with us, Michael, and I would like to thank you for coming on Chat with Traders.
Yeah, I feel very grateful. I know you've had some really great people over the years. It's a legendary show. Everyone should really make it, if you're looking to trade and learn your craft, spend a lot of time going through these interviews, because it's really a who's who of trader excellence on this channel.
Fantastic. How can our listeners reach you?
So at Trader Mindset, there's I can give you a link if you want. I wrote a book in 2011 called The Inner Voice of Trading, and I give away the audiobook version for free just to kind of help people. I can give you the link. You can put it on it's basically tradermindset.com/CWT for Chat with Traders. It's free. You can just go get it and download it.
Fantastic. Yeah. Thanks for coming on the show.
Ian, great interview, man. Thank you very much for asking really interesting and very challenging questions. Really good.
All right, great.
Hey, Michael, that was awesome. Lots of great golden nuggets. As you were talking, I had a few questions that I wanted to ask you. Actually, I had 3, but maybe we only have time for 2.
I have all the time in the world for you. So just.
Okay. All right. If you had to start over in your trading career, and if you can choose only one thing, what's that one thing you would have done differently right away?
I think I would have started my own company a lot sooner, knowing what I know now, and even borrowed money or got backers to grub stake either a trading account or to capitalize my firm, to just go out on my own. I'm pretty much a lifelong entrepreneur, and I had to learn somewhere, so I don't regret it, but I could have had more efficiency if I had gone out on my own sooner. But it all happened for a reason, and everything was a learning experience. So I'm not a person who has regrets. Everything played a part in my evolution as a human being. There were certain people I didn't like at the firm, but you have to take the thick with the thin and just focus on what of it can you actually use and keep moving forward.
And what drives what you do now?
Philanthropy. I've already gone through the wealth accumulation stage. Obviously, I'm still making money, but now it's like I want to have a full karma bank. So on the low end, I give away the audiobook version of my book. It's well over $1 million worth of audiobooks value. If you charge, say, $30 for a book, that's what they tend to go for. It's not about trading commodities or whatever for all these fat cats who already have an enormous amount of money. It's more like, how can you help nonprofits, foundations, endowments be around for like the next 50 to 100 years, right? So that they can go execute their plan, right? So that's kind of the role that we play there. And then with my own money, what can I do to give money away in philanthropic causes, to help people put a little wind in their sails?
You're truly inspiring. I'm so glad that I checked out your YouTube channel. As I told you last time, I'm an active trader, and I was going through some mindset issues. And so I was searching for some content that would help me. And so I found you, and I found that, you have this really real way of speaking and speaking from the heart that just really clicked with me, resonated with me. I'm sure that many traders would feel the same way. So I just want to say thank you for your philanthropy and for your contributions to the trading community.
You're welcome.
Yeah.
I'm glad it helps. I'm glad you found it and that it has meaning for you. It's all, an evolution. So as long as you're clear about where you want to go, I'm pretty sure you're going to get there. It's just like, do you have the clarity? That's really what it comes down to. I always say, like, in the masterminds that I run, or from time to time when I do one-on-ones, the first thing we talk about, they're like, what about sugar? And should I be piled into cotton? I'm like, we're not even going to talk about that. We're going to talk about the clarity of what vision do you have for yourself? Because you have to see the point B. If you're at point A, you have to know what your point B is. Even if you don't know how to get there, you have to have that vision. So I think if you have that vision for yourself and you can see yourself being a certain type of a trader, that'll likely, your behavior is going to kind of converge to where it needs to be so that you can get where you need to go. That's how I've manifested almost everything in my life, is to envision being somebody like a completely different person.
Yes.
Like almost having an identity crisis about it too. Like just being a completely different, like, doing things out of character. Like I had, when I was, first going to Wall Street and starting to do well for myself, I had people from my hometown who, I don't know that they had envy, but they were kind of like, look, you're a hometown kid from New York and your dad was in a labor union. What are you going to an Ivy League school for? They used to say something like, it's a very New York way of saying things. They could go, check out Martin. He thinks who the hell he is, which is a way of saying Martin's full of himself. They'd be, check out Martin. He thinks who the hell he is. And I'd be like, I don't think who the hell I am at all. I'm just pushing myself to achieve, higher levels of achievement based on my abilities. There's no sense in slacking off or not using any of the gifts that God has given me. And if I fail, I know I could come back and be you easy. No, I didn't say that. That would be arrogant. But that's where my mindset was, is like, why would these people just want to coast through life and not push themselves? Like every day, I'm not saying push it in the market or push risk, but a person has to have goals every day and take steps. Even if you don't know what step 2 is, take a step, hold one mini or one micro contract overnight just to see what it feels like. Or, buy an option contract and hold it overnight and just kind of see what it feels like so that you could learn to manage your emotional intelligence around managing risk, right? Or investigate, why do you take your winners too soon? Like, what would it mean if you had
fear?
Right. But a fear of what though? Like say you had a trade, it was up $200 and then it came back and it was flat. Like what would that actually say about you?
Yeah.
To me, nothing, because markets move. They go up and they go down. And it's not necessarily a missed opportunity, because a lot of times that's what happens with trades. They go up, they go down, then they continue their move higher. But that's your journey.
Another thing that I really got out of the chat you had with Ian is that I think is actionable is don't overthink things. Like you said, don't overthink things, and basically to trust my process and be good at executing.
Well, this is true for life too. Like there's so many overlapping tenets for trading that really apply to life, and that's focus on your process and kind of stay out of the results even, like, because a lot of people do what's called resulting. The thing with resulting is we have, you could go on and put on a real reckless trade, make a ton of cash, and then look at that and be like, man, this is easy. Like that's how you do it because the result was favorable, right? So you go back and validate the process, which was really reckless behavior. There's even other things that are a little more subtler, like you put a trade on, but you don't have enough risk. So it does make money, but you made money and you're like, okay, so now you're coaching yourself to kind of get used to being a small winner. And that becomes a mindset. So because you're validated about the accuracy, like this is a thing that really smart people, if they went to good colleges or, they were just very good students, they're really tied up in the accuracy thing because it validates who they are. It's what they're used to.
Right.
So it's very difficult to get out of the accuracy game and start to think in terms of expected values. Like what would happen if you had utter academic failure at say 40% accuracy, but your winners were 5 times the size of your losers? Like that's someone who's going to make millions of dollars. So that's why I think like begin with the end in mind. Who do you want to become? What do you want your money to do for you? Is trading just a vehicle to validate your intelligence, or is it a vehicle to make ungodly sums of cash? Because that's what I wanted it to do. I didn't want to be broke. I was tired of being like living, I was 2 or 3 months ahead of my bills, but that was it. Like I had enormous fear. And I was in New York City where everything is $20, I mean, it's like so.
Yeah, you brought up the accuracy thing. That's exactly kind of what I'm going through right now. I'm probably 83% win rate, but my reward to risk is very low. It's probably because I'm taking small wins. Yeah. And so That's a good point.
Are you taking risk home overnight at all?
No, I'm scalping.
Okay. And so you asked, okay, Tessa, so I don't give unsolicited advice. I've always thought unsolicited advice is a form of criticism. But I was in a spot in my life like this as well, because I wanted the validation, right? I wanted to be able to call myself a trader, like, because trader presumes that you're profitable, right? You can't say after 5 years, like, I'm a trader, and you've done nothing but create tax loss carry forwards for people. Like, you actually have to make money. So there was the time where that validation really meant something to me as a human being, as a guy, because like every guy, I have a fragile male ego, right? So I wanted to have that badge, if you will, that social proof that I was a profitable trader. But profitability too has to be operationally defined. So one of the things that I did was I looked at my P&L and I said, okay, I've made X amount of money on this trade, or I made X amount of money this week. Divide that by minimum wage. And that's how many hours I would have had to have worked to earn that money. And so that's like a little trick that I used to use to coach people so that they didn't get excited. If you could work at Chick-fil-A for $20 an hour and you make $200 trading, like that's a 10-hour work week. That's something that you could do in the physical world. So the trading part isn't really exciting. Now, if you're pulling down 5K or 2,000 a week, then you divide that and you're like, okay, that's a 100-hour work week. That's really not something that I could do and sustain. So now I know I'm leveraging my time because I'm bringing out of the market more money that I would have to work at a salaried job somewhere, for example. And I'm my own boss. I could work from home. I could talk with Michael Martin on the camera and not go on camera. Does my hair look okay?
Yes.
I just went to Dry Bar.
Yeah, good point there. Lots of things to think about, but overall, I feel like I'm progressing. So yeah, it's just,
And that's huge. Like, you
Yeah.
really have to love yourself in all of this because there's nobody to really do it for you. I don't mean to cut you off. Like, feel good about where you are. You're doing a great job. And it's all, as they say, progress, not perfection. Love yourself. You're doing very well.
Thank
If
you.
they didn't carry you out of the game yet in a body bag, you're doing better than most. 95% of the people lose money. That's 19 out of 20.
I don't want to be in that 95%. I work
not,
every
but-
day to not be in that. Like, seriously, I work every single day to not be in that 95%.
You just want to be aware of your behavior because the behavior is going to carry you or not to where you think you want to go. And usually you'll come to a crossroads and say, man, I'm putting in a lot of work, but I'm not getting the results. So something has to change. And it's like when managers would go to see an employee that wasn't producing whatever they had to produce. There's a kind of play on words. They say, you either have to change the man or you got to change the man, right? Meaning like, okay, here's what's not happening. Here's all the resources we can give you to help you. Here's when it has to change by, and here's what's going to happen if it doesn't change. Like, we're going to reallocate you to another department, or, you're going to be out of your job.
Right.
And so I would have those conversations because I already, by the time I got to Wall Street, I was in my early 20s. I had worked since I'm 12. So physically, I was exhausted from working. And that's not a complaint. It's just the reality. I had started working and cutting grass in my neighborhood and trimming hedges when I was 12. And I had, not in the middle of the school year, but there was really no time for me to not work. I would do things and pick up a $10 job on a weekend by raking somebody's lawn, or I'd help somebody move furniture. Like, I was that kind of guy Friday who would help people in the neighborhood. And then, when I started to drive, I did that. And then, I kind of said, okay, for all the work that I'm going to do, I want to make sure that I could make the most amount of money. So I did things like I delivered flowers, and they were like, okay, you're going to get a lot of tips. And I didn't. And so I was making minimum wage, but I wasn't making any tips. So I was like, okay, I have to up my hourly rate. Where can I make a lot of money? So then I thought, like, okay, waiters can make like $100 a night. So I said, oh, that's pretty cool. So I just started applying to restaurants and working as a waiter. And, I got in remarkably with no experience. And then same thing with golf caddying. And then after that, when I made a lot of money, doing those jobs, I was like, okay, now I have to figure out how the other half live. Mm-hmm. I need to figure out a way to use my brain. And I remember exactly where I was on the exact day of the week. I working at a restaurant in New York in Westchester County. The name will come to me in a second. The place was called Traveler's Rest, and it was a German cuisine place. So they had Wiener Schnitzel and all that kind of really good German food, if you like it. Dumplings and this and that. And Millwood, it was in Millwood, New York on Route 100, which is kind of right in the very Tony part of town, Westchester County. And we were also open on Monday nights. Most restaurants in the fancy ones were dark. That was like their day off. And I remember it was a Sunday and I was setting up tables at, because we would open at 1:00 for like an early lunch. And I was there probably 11:30 setting up. And on the music system, they had Yesterday, a song by the Beatles that Paul McCartney wrote. And it was like the Dentist Muzak elevator music version. It wasn't Paul and the Beatles, but it was a stylized version with, violins and
instrumental.
Yeah, exactly. And I remember thinking like, man, Paul McCartney's getting paid for this now. He wrote the song once in the 60s. It's 20 years later and he's still getting paid. Like, I got to figure out how do I get paid for not working? Which sounds ridiculous to a working class person. But when you think like a business owner, it makes perfect sense. So I had to approach trading in a way that, how can I trade while not being there? How could I treat trading like a business that I own, that I don't have to manage? So I can put in my stops and walk away, because the clearing members have every incentive to want to, execute my trades for me. You know what I'm saying?
You know what I noticed, that you, like all along your journey, it sounds like you ask yourself all the right questions all along. Like, I think most people don't ask and think about.
I always had an inner voice. Like, I always was very reflective and meditative and spiritual. So I always kind of thought things and say, what's not right in the world? What's not right with this situation? I'm feeling energy from people. And I always listened, not just for what they were saying, but how they were saying it. Like, what did they want? What were they trying to convey? And then ask myself really good open-ended questions, not these endless loop, like, why does this stuff keep happening to me? Like, that doesn't go anywhere,
I have to stop doing that sometimes.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.